Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Justin.
Okay.
Thank you very much.
You're very welcome.
You're right on the money, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
Welcome to another edition of Talk Money. Thank you for tuning in. We are here to help you make the important financial decisions. Ultimately, our goal is to improve your money IQ. If this is your first visit, my name is Jeffrey Shank. I'm a chartered financial consultant and owner of Andover Advisory Group, a registered investment advisor. If you'd like to get in touch with me after the show, please do so. Don't hesitate. If you have a question or you have a concern about your personal finances, something that maybe somebody has been talking to you about and you just haven't been able to figure it out, please give us a call using the toll-free number, 877-475-2062. You can send me an email. It's jeff@talkmoneyradio.com. You can just send us a private message right through the Facebook page. We'd be glad to talk to you. And, of course, you can always set up a no obligation, no cost initial meeting. Consultation.
Yeah.
That's the word I was looking for.
Yeah.
Thank you.
Yeah.
And
by the way, that can be about a specific thing. It's not just an orientation. It's not just, hi, I'm Jeff Shank.
Right.
If you have a specific issue that you're dealing with, you can talk about that and get some useful information.
It's not a timeshare presentation.
It's not a timeshare. No Klieg lights.
And you won't. And unfortunately, we won't give you a free gift either.
Oh, okay. That's fair enough.
You know, funny thing is
knowledge. You give the free gift of knowledge. Jeff.
This probably goes back to the 80s, but I was talking to a client about a timeshare event that they attended, and it was a free cell phone, and they went to get a free cell phone when cell phones were disposable. weren't disposable, and not everybody had them, and so wow, free cell phone, that would be great, right?
Yep.
And car phone. I take it back. I apologize.
Oh, wow, this is going
car
back.
phone. Yes,
car phone.
80s.
Yeah.
Yes, this was the 80s, right? So it was a free car phone, right?
Wow.
Wow, we're taking a trip down memory lane, huh?
Yep. That big bag and
the bag phone.
Yeah.
Did you have one?
No, God, no.
You didn't?
No, I was late to get a cell phone because I kept saying I don't want people to have that much access to me.
Oh, is that right? Yeah. So you resisted.
Yes.
Yeah. I've still got my bag phone. I think it'll be an antique. Well, it probably is already an antique.
I didn't get the cell phone until we were close with Sarah, my firstborn.
Oh, okay.
And actually, I resisted. I carried a beeper for a while to give you an idea.
Yeah. So that people can get in touch with you.
Sarah's mother said, "No, you're taking a cell phone." So, okay.
So it was a car phone.
Yeah.
Right. So they went to this timeshare for the car phone. They resisted. They didn't. Okay, fine. All right. Right. Then they finally realized they weren't going to be buying anything. Okay. So, hey, where's my free car phone? Oh, and they handed them a box. Right. And it was just a regular
a phone shaped like a car.
Shaped like a car phone.
Oh, God.
Is that good?
No, that's not good at all. But did the people who sign up get a car phone?
Who knows?
Yeah.
Who knows?
That's the big question.
Who knows, right? I don't
it's great.
Don't think you can get away with that these days.
What was his general impression of it? Do you remember his general impression of the timeshare meeting sales pitch?
Guy is boring. He just wanted the car phone. So it was like, hey, get me to the part where I can get my car phone, right? So
I'm just excited. There's a whole industry around breaking timeshare contracts, apparently.
Yes.
I hear ads all the time.
Yes.
Yeah.
Yeah. Yeah. But it's funny. The timeshares have got a bad name, but I know a lot of people that own them and swear by them. And in fact, a client of mine did a lot of study on timeshares. Went to one of those things, bought a timeshare,
Yep.
and then realized that she probably overpaid for it. And you can buy these things on the secondary market. As opposed to brand new construction sitting for one of those presentations. And she ended up buying like 3 or 4 timeshares on the secondary market, primarily. And I used to refer, so I had clients come in. I wasn't an expert in timeshare.
Yep.
And I had clients come in that owned them and said, what should I do? Should I keep this thing? And I said, you know what? I've got the expert on timeshare. I mean, she did a ton of study and was very experienced at it. And she bought the timeshare not for the actual week or 2 weeks or whatever it was at that particular location, but she bought into the network and was able to exchange
a trading
her week.
Yeah.
Right, exactly, for another. And she took full advantage of it. She did well with it.
Excellent.
We actually looked at we looked at the numbers. We crunched the numbers, and she, when you compared it to paying for a hotel or whatever, she did well, and there was some pretty decent locations that she was able to visit as a result of her ownership. So,
like anything else, just go in with your eyes wide open and be smart about what you're doing.
Yeah, and she turned what was potentially a negative into a positive. Mm-hmm. Yeah. So I'm not the expert on timeshares. If you have one and you're trying to break the contract, I don't have anybody that in mind that can help you do that. But you're right, Lou. There is an industry out there that will help you to get out from under your timeshare. So hey, got a good show lined up today, I think. First of all, we're going to talk a little bit about the new child tax credit.
Excellent.
Did you know that every year student loan interest rates change for new loans?
I would imagine.
And they are all based on a treasury auction that happens in May.
Really?
And so now we know what the new interest rates are because of the latest treasury auction. So we're going to talk about the change in the interest rates, and take a guess.
They went up.
They went up.
There's a treasury auction?
Well, yeah, the U.S. government raises money by issuing bonds.
Yes.
And they auction those bonds to the highest bidder on a regular basis.
Yep.
And that's where we get the prevailing interest rate, because the price that someone is willing to pay is a function of the yield.
Right.
And so
as yields go up in the free market, the auction prices will go up.
Depends. And so it's an indicator as to the appetite that people have for a particular issue and a particular yield. So the yield will adjust as it's being auctioned to get the best rate for the government, but also will get them sold so that the government can borrow the money, right? And so there's a meeting of minds between the buyer and the seller. So in this case, the U.S. Treasury, and the buyer being the market, in a lot of cases banks, and the yield is determined based on those auction prices.
You mean like a free market? Okay.
Like a free well, yeah. And I said banks. You know what? The Federal Reserve is a big buyer of a lot of those bonds, by the way. So so interest rates did go up, and I want to go over the details of that. Plus, we've got this week's Talk Money tip, which is all about SEPP, which is a way to pull money out of your retirement accounts without penalty before you turn age 59 and a half.
Oh, I see.
Yeah. So
yeah.
Well, so let's start with the new tax credit, Lo. So they're increasing the child tax credit for 2021. Mm-hmm. You probably heard about this. And it depends on the age of your child. So
Oh,
if
it's prorated. Your child is prorated.
prorated, no,
Yeah.
it's pretty much if your child is 5 or younger at the end of 2021,
Mhm.
then the child tax credit is equal to $3,600. So if you have 3 children under the age or 5 and under, you get 3 times $3,600.
Mhm.
For each of your qualifying children age 6 to 17, it's $3,000.
Mhm.
So $600 less up to age 17. And then 18 or older, no child tax credit. There is a separate dependent tax credit that you can get, but I think it's $500 or $600. So it's nowhere near the amount of the child tax credit.
Yes.
Again, 5 or younger, $3,600. Each of your qualifying children between 6 and 17, $3,000. By the way, that used to be 16, I think. So they raised that age
Yep.
to give you a larger child tax credit. So, but that's not the end of the story. Why? Because there's a phase out.
Yeah.
It's means tested. So you don't get the full tax credit if your income exceeds a certain level. And so I think I've got a
Yes.
graphic. Okay.
Mhm.
And there's 2 phase outs, Lou.
2.
There's 2 phase outs. Okay. So the first phase out reduces the child tax credit from $3,600 or $3,000 down to $2,000, potentially maximum of $2,000,
Because it's getting cheaper to raise a child.
because you can afford I
I
guess to raise those children more than someone else whose income is lower, so you don't get as much of a child tax credit.
Pay your fair share.
You have to pay your fair share.
Yeah.
Exactly. And so here's how it works. So if you're married, filing a joint return, or filing as a qualifying widow or widower, if your income exceeds $150,000,
Oh, those rich people.
if your income exceeds 100 adjusted gross income, so that would be wages, pensions, distributions from retirement accounts,
you're a
interest, dividends, capital gains,
If you're a
adjusted gross
firefighter,
income,
if you're a firefighter married to a teacher,
you're probably over 150.
oh God, yeah.
Yes. Yeah. And if you have kids 5 or younger, guess what? You don't get the full child tax credit.
Yep.
And so, and it's 112.5, by the way. That threshold is 112.5 if you're filing head of household. So that's better than single, because single is 75,000.
Yep.
Right. It would be hard for someone who is single that has a qualifying child to only be able to file as a single individual.
Mhm.
Typically, you're filing head of household.
Right.
But nonetheless, there is a separate threshold if you're single. Okay.
Mhm.
And the first phase out reduces the child tax credit by $50 for each $1,000 by which your modified adjusted gross income exceeds the income threshold.
Okay.
So I did the math. I think it's $20,000. So from 150 up to 170,
All right.
you get a higher tax credit. You lose part of that tax credit, but
Right.
not all of it. Right? Down to a maximum of the minimum amount of that tax credit. Even if you're over 150 up to 170, you still get a $2,000 tax credit. Even if you're over 170, you still get a $2,000 tax credit. You lose $1,000,
Right.
essentially, right?
Yep.
Now that I think of it, I didn't do the calculation if it's $3,600. So bottom line is it goes down to maximum $2,000. If you're over 150 up to a certain amount, you lose $50 of the tax credit again for each $1,000. Or fraction thereof by which your modified adjusted gross income exceeds the income threshold.
Mhm.
So you come up with a ratio, bottom line, and you get a portion of it, but not below $2,000. So you still get a $2,000 tax credit even if you exceed those income thresholds.
Right.
Got it? Clear?
Yep.
Okay.
Not something I have to worry about, but okay.
Well, let's look at the second phase out. Right?
Yep.
Is that showing on the
Yes.
screen? Okay, good. Okay. So the child tax credit doesn't get reduced below $2,000. Remember, I said the minimum
Right.
is still $2,000, even though you're above that, until you reach that $400,000 threshold.
Yeah.
Now you start to lose again $50 for each thousand or fraction thereof by which your modified adjusted gross income exceeds the income threshold
Mhm.
until it goes away entirely. So it's a, I don't know. We could do the math here.
Yeah.
Another $2,000 times, so that would be $50. 2,000 be 40 times, right? So that would be $40,000.
Yeah.
Yep. So once you get to 440, you lose the tax credit altogether. That's if you're filing a joint return. If you're all other filing statuses, it's a 200,000. So it doesn't matter. It's not a separate one for single and
Right.
a separate for a head of household. Everybody else, the threshold is 200,000, which seems kind of, I don't know, harsh to be
The
quite honest with you.
whole thing seems kind of harsh.
That you wouldn't be able to get the tax credit if your income is above a certain level. I'm not sure
Yeah.
what you mean. What?
Yes.
Yes. So you should
You're
get the
raising
tax credit
children.
regardless of your means.
Yes.
Is that what you're saying?
Yes. I should be penalized for being successful. And like I said, the first phase out is a firefighter and a teacher. It's not exactly the 1% here, although it probably is the 1%.
What is your example for the $400,000 level?
400,000
Yeah,
jointly.
Teacher, and
That's a
Wall
tenured
Street.
teacher and a cop doing a lot of detail duty.
Immature maths.
Yeah. Well,
Oops.
let's not go there.
Oops. Sorry.
Yeah. There you go. A sergeant in Methuen, and a tenured teacher.
A tenured teacher.
Yeah.
Sorry about that.
Yeah.
I don't mean to cast any dispersions
No.
on the police department in the
No.
in the city of Methuen.
Yeah.
I love y'all. Yeah. When you get pulled over.
Do you have to go through Methuen on your way out here?
Quite a bit of time.
Yeah.
So anyway, so you're probably saying, yeah, Jeff, okay, great. This is June. We're almost July. We're in the middle of the summer. Why are you talking to me about tax credits? I'm going to worry about this next January, February, or March when I do my tax return, right? And how much I'm going to get, right?
Right.
Well, one reason would be, hey, you might want to plan for this because if you hit that threshold, you're going to lose some of the credit. So maybe you can manage your income and plan to reduce your income if you're close to that threshold. But that's not the only reason that I'm bringing it up.
Oh, well, what's the other reason?
The reason that I'm bringing it up, Lou, is because what's new with this tax credit is in advance on that credit.
Oh.
So the IRS on July 15th will start sending out payments to anybody that they've determined qualifies for the child tax credit.
Based on the previous year's tax return?
Based on 2019 and 2020 tax return.
Wow.
Correct. Yep.
You know my next question.
Your next question.
Yes.
How much?
So if you qualify,
yes,
and you
based on 2019, 2020,
right, and you get
yes.
paid the child
you
tax
get the
credit in
advance,
right?
Yes,
and your return shows that you're less qualified than you
so
were.
for 2021,
Yeah.
you realize when you file a tax return that you are not eligible for the tax credit,
or at least the complete tax credit or whatever.
Yeah.
Yeah.
What happens?
Payback and penalty?
Penalty, no. Payback, potentially.
Yeah.
Yes. Yeah. So let's just look at who's eligible for the advanced child tax credit first. Okay. So you had to have filed the 2019 or 2020 tax return.
Mm-hmm.
You had to have claimed the child tax credit on the return, or you provided your information in 2020 to receive the economic impact payment using the non-filer's Enter Payment Info Here tool on the IRS's website. So in neither of those cases, so if you didn't file a return for 2019 or 2020, but you signed up for the stimulus payment, and they deem that you qualify based on the information that they have on file, you're also eligible to receive an advance on the tax credit.
Is the tax credit refundable?
Yes.
Yeah.
Yes, it is. Key portion of it. A key provision of this is that a portion of it is refundable. I don't know the details on that.
Yep.
So we'll have to follow up. Also, this is important. your main home has to be in the United States for more than half the year in order to be eligible for the advanced child tax credit.
Okay. What
Kind of important.
What person in the IRS is verifying where you live half the year?
Yeah, that's a good question. That's a good question.
Yeah.
I mean, based on other information that
Sure.
they may have available to them, right?
Yep.
You have to have a qualifying child who is under the age of 18, as we said before, right? Up to age 17, you're eligible for the child tax credit at the end of this year. So if so even if you had a qualifying child in 2019 or 2020, but now they've turned age, they will be 18 by the end of the year. Not now, not in July, but by the end of the year, then you're not going to qualify. And all of those qualifying children have to have a valid Social Security number, and obviously you have to have made less than the income limits, right? So, starting July 15th, the IRS is going to start sending people advances on the child tax credit, 100%.
Is there another example of an advance payment by the IRS?
I'm sorry, not 100%, 50%.
50%.
50% of the total.
Has the IRS done this in the past? An advance payment on your, I mean, I guess all of the stimulus checks are that, right? They're advanced tax credits.
Correct.
Mm-hmm.
That's one good example. Another good example is the health insurance tax credit.
Oh, yeah.
Where if you bought insurance, one of the policies through the marketplace, they would, and you were eligible for a tax credit, or actually you would estimate based on your prior tax returns, your current situation, you would estimate the amount of tax credit you'd be eligible for, and they would give you an advance to pay the premium.
Yeah.
Right. So you wouldn't get cash. They would just send that advanced tax credit to the insurance company in order to subsidize the premium that you're paying. Fair enough. That is another example of the advanced tax credit. What I was going to say about that is that people who have, let's say, get 2 kids, 5 or younger, $3,600, 50% of that, $1,800.
Could help some people,
right?
Yep.
That's $1,800 over a course of a year is $150 a month. So you got 2 kids, that's $300 a month that you're going to be getting as an advanced tax credit. You'd want to make sure that if you're eligible for this, that the IRS has all of your information on file and correct. My guess is that they're going to do the same thing that they did with the stimulus payments. They're just going to direct deposit it into your account. So if you registered your bank account and we're getting stimulus payments, that's probably where that is going to go. If you've closed that account for some reason, you might want to log into the IRS's site and make sure that your information is up to date. To ensure that that'd be the fastest way for you to get those payments. But what happens if, like you said, you don't qualify? They deem that you qualified, but you know that in 2021, at the end of the year, you're not going to qualify. Well, it depends on your circumstances. There is going to be a forgiveness for certain individuals who, through no fault of their own, and because their circumstances are not such that they could afford to pay it back, they're going to forgive those advances. So it's going to be a lot of money sent out to a lot of people who wouldn't be able to claim the tax credit, but because they got an advance, they're going to get to keep it.
Okay, clarify for me here. Beginning in July.
Yes, July 15th.
Get an advance refund for the 2021 tax year. All right.
Correct.
Okay.
Yep, and this is only for 2021, but my guess is this is going to become
this is a one shot.
My guess is going to become a popular a popular program.
I see.
Yeah.
Oh, I didn't realize that. Yeah.
Who was it? Andrew Yang. Wasn't it Andrew Yang who was a presidential candidate who was talking about $1,000 a month to all that the government should just give everybody $1,000 a month?
Oh, there's a lot of people on one side of the aisle who are looking for that sort of thing.
Yeah.
Which, by the way, as I get older and as the government keeps working us over,
Yes.
I keep
You're
thinking
all
to
for that?
myself, I'm
You're all for that?
starting to get on board right now.
Well,
Given what the government did to me the past 12 months, yeah. And then it's not like they're taking it from people; they're just sort of printing up the money. So
yeah. So I said no. So I said 150. No, it's $300. It's
Yeah.
going to be $300 because you're going to get it for 6 months. That's $1,800. I take it back. So I was thinking about that as I was saying it and saying you're only eligible to get half of it this year, but you're going to get the full monthly amount. So right. So if you've got this is like 600. If you got two qualifying kids, it's going to be $600 a month.
So they will pay on a monthly basis, or they give you a lump sum?
No, it's coming out monthly.
Oh, I see.
It's coming out monthly.
That's a good idea.
You like this idea?
I do. Well, it's
I'm starting to question your conservative.
well, like I said, I'm getting older.
You're
and
getting older.
I'm getting older, and we're losing the battle. So
So what the heck?
I want to get mine
Oh.
while I still can.
Gonna have another kid.
No, it's not happening. It's not happening.
Don't recommend it. I'm
No.
not recommending it.
Yeah,
But I don't know if $600 a month could offset the,
this is an
the
advance.
cost of raising a child.
This is advancing your payment, but I guess, so in one way, it's cutting into your payments for next year. Although next year we don't know this is in effect, right?
My guess is this is going to become very popular, and
Yeah.
we're going to see this continue somehow, some way. Maybe you'll get half of it because they don't want to give out too much money. You only end up getting half of it instead of 100% of the monthly amount.
Yep.
So you end up getting half because they're starting July 15th.
Yep.
You're going to end up getting half, even though they're paying you the full
Right.
amount that you would get if you divided the
Because the
tax
advance
credit
is
by
for
12.
half a year.
Because the advance is for half the year.
Yeah.
That's how it's working out. Wow. So again, that's for somebody who's got two qualifying kids, that's $600 a month. Getting
Yeah,
pretty
man.
close to that $1,000 that Andrew Yang was talking about. That was my point.
Pretty close.
Yeah. Yeah. So
Honey,
if you
let's
don't
have a third kid.
if you
Get
don't
that up to $900 a month.
I don't know if there's I'm not sure if there is a maximum amount. They well, if you're eligible for the tax credit, I don't know why they would, right? Why would they put a limit on it, right? So listen, if you a couple of things here. So if you're not going to file a tax return, you haven't filed a tax return because you don't have to, and there are a lot of people out there that could, but still are eligible for this tax credit because it is, a portion of it is refundable. The IRS has a non-filer tool that you can use. Just go to irs.gov and basically it's the same tool that allowed individuals to register for the advanced child that allow people to qualify for the economic impact payment.
Yep.
And if you don't want to receive your monthly payments, don't know why you wouldn't if you're eligible for it, but if you're not going to be eligible for it, and you'd rather not have to pay it back, and you don't want to get involved with that, you'd rather just wait until you file your tax return and claim the credit because you don't want those payments coming to you. There is a place that you can go on the IRS's website. Let's see. It says here you can unenroll through the Child Tax Credit Update Portal.
Wait a second. You have
CTCUP.
You have to opt out?
Yes, sir.
It's not assumed you're opt out and you have to opt in?
No.
Oh my God.
That's why I bring it up.
Oh my God.
It's
Wow.
2 weeks away. You're going to start getting payments. So you have to opt out. Otherwise, you're going to get payments if they've determined that you're eligible. And keep in mind, anybody that is making less than $400,000 a year is eligible for at least some portion of the tax credit. So they're going to start sending it out.
Wow.
Yeah. How's that?
God bless America.
You know what I just thought of, and it's
What?
kind of not a very good thought, but
Why I think I'm going to
well, so no, somebody if they're sending you the payments and an eligible child were not with you at the end of the year for some reason, death or some other reason.
Well,
right? How do they?
They're going to waive that.
I don't know. I don't know how that's going to work. So I guess you don't have to opt in. You do have to opt out. So if you don't want to get the advanced child tax credit and have to pay it back for some reason at the end of the year or when you file your tax return next year, you use the Child Tax Credit Update Portal.
What a world. What a world.
Yeah. So I thought that would be good information for
I know
for our audience.
this was happening.
And I think a lot of people are going to be surprised.
By the way, you don't opt out and you start getting those checks from the IRS and just tossing them away. Like what people did with the stimulus check.
Oh, you mean accidentally tossing them away?
Well, no, it's just like you don't know what it is. You're not expecting a check from the IRS.
So you just throw the envelope out, you mean, without looking inside it? A lot of people got...
Didn't we have a lot of that with the...
No, actually what happened was they issued
cards.
Debit cards. Yeah. And so folks didn't understand that their stimulus payment was going to be put on this debit card. There wasn't enough. But yeah, keep in mind what was going on at the time. And it was just like, they were just trying to figure out how to get... I mean, they didn't have the helicopter working at that time. So they had to come up with some other way of getting money into people's hands, right?
Well, if I were a direct mail marketer right now, I'd be making it look like a treasury check signed by Donald Trump or something.
So, so in order to get your attention, you mean?
Yeah, people are going to be looking for these checks.
The checks,
so
right?
Just send your direct mail advertising.
Yeah, my guess, and I don't know this for sure. All the stuff I read didn't really say so, but my guess is that a lot of it's going to be direct deposit.
Yeah.
So you don't have to worry about...
Everyone's pretty much set up these days.
Yeah, right, exactly. So, hey, let's take a break here, Lo, and when we come back...
Think about that. A few years ago, would you have thought that most of the country would be set up for direct deposit from the federal government?
No, I remember when it happened, I said, how are they going to do this? And I actually made a comment on the show saying that, what do you think is going to happen now that the government knows that they can just push a button and put money into people's accounts?
Yep.
This is an example.
Fire up the helicopter.
This is an example, I think, of that particular concern of mine.
Yep.
So when we come back, we're going to talk about student loan interest rates and the new rates that you're going to be paying if you're taking out new student loans. Stay with us. We'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back to Talk Money. So after 2 years of decreases, interest rates on federal loans, student loans, are going to increase.
Wow.
So here's how they do it. We mentioned at the top of the show.
Don't worry, you're probably not going to have to pay them off anyway.
I was thinking about that throughout the whole time I was researching this particular topic. Yeah, I'm saying, I actually had a client ask me, we talked about me paying off the student loans. You think that's a good idea if the government...
Isn't it a pretty decent roll of the dice at this point?
So, first of all, it's something that has to be voted by Congress.
Yeah.
It's not something that the president can do unilaterally.
I understand.
By the way,
But the party's one vote away from... Well, actually, they control both houses.
I believe that the deferment, because of the pandemic, ends in September of this year. So my guess is that there will probably be some emergency order that's going to extend that deferment for a little while longer, while they contemplate the possibility, I guess, of forgiving some student loans. And interestingly enough, I did see a discussion, and it was on one of the news stations, and they were talking about student loans and the possibility of forgiveness. And I forget the gentleman who was on there, but it sounded like he was pretty familiar with the whole process, part of the education department, at least at one point in his life. And he indicated that it's something that a lot of people are pushing for. But he did suggest that it would be means tested. And so the person client I was talking to, I said, look, this can't happen unilaterally. It's got to be voted by Congress. Are all your student loans going to get paid off? Probably not. And chances are it's going to be means tested. So guess what? You're probably not going to qualify for it anyway. But I think you're right that there is that possibility. And one of the questions that this individual was asked, I forget his name, so my apologies, was, what about the person who didn't take out loans?
Yeah.
What about the person who just paid off their loans?
Yeah.
Are they gonna get a refund? Are they gonna get they gonna get some money back?
What's the time frame here? In other words, would they be you're 20 years into your student loan payments?
Yeah, right, exactly.
You paid off X amount of percent of your student loans.
Yeah.
What happens?
I just can't. So here's the problem that I have with this whole thing is I just can't imagine a scenario where you can make this fair. Not that matters, but I just don't see how you can make it fair. So I just don't understand how they could do something like this without. I mean, there already are forgiveness programs. You know that, right?
Yes.
But it's a give and take, right? So you don't just get the forgiveness because you happen to take out a student loan.
Right.
I mean, I think we talked about this last week on the show too. People who are taking out loans didn't have the cash typically don't have the cash to pay.
Right.
So the families that over the years have saved money, given up certain things, put money away for their kids for college, paid for it in cash, they're penalized basically because the same family who spent all their money on vacations and big cars and big houses and took out the loans, they're going to be forgiven. That doesn't make any sense.
We did a third, and a third. So the student loans were 1/3 of the entire tuition.
Right. Yeah. So
and by the way, we'd pass any means test.
Well, there are forgiveness programs already, but they require you to do something in return for that forgiveness. And an example is you work in a nonprofit, right, or a government program, a government, you're a teacher, right, for example. You can have the balances of your student loans paid off as long as you stay in that job, because what they're saying is, hey, you gave up some income in order to help out society. We're going to forgive a portion of your loan. I have no problem with that.
No.
Right?
I think it's just a program,
blanket,
actually.
Just a blanket forgive student loans. I can't think of a scenario where you could actually make that fair to everybody, and it would only be, well, maybe not a small portion of the population, but it just doesn't make sense. And by the way, and if they do it, it's probably not going to be 100% of your student loans. It's going to be up to a certain maximum they're going to be willing to forgive in certain loans. But anyway,
do you remember the series Northern Exposure?
Oh yeah.
Where the town paid a loan off of a doctor in exchange for service.
Yes.
In the middle of Alaska.
Yes.
Yeah.
Yeah. Exactly.
Yeah.
Right. Same
a bad thing. Program, actually.
No. You're getting the forgiveness in exchange for giving up some income. So it's costing you. You're not getting it for free.
The sizzle is getting your student loan completely forgiven. But what the actual legislation is going to be, should we ever get there, is going to be something completely different.
Yeah.
Plus, they're going to have to pick a window. They're not going to be able to do every open student loan.
How do you pick it?
Right.
How do you figure that out? So, by the way, this individual totally avoided the question.
Oh, really?
Totally avoided the question.
Yep.
And just said, well, see, by doing something like this, we're going to help out those people that because we're removing the burden of these loans, they're going to be able to better participate in the American dream.
Yeah.
Sounds great, doesn't it?
It sure does.
Doesn't it?
Where's that burden going? Because
Who's
it's
paying
going somewhere.
I'm paying it. You're paying it. I mean, that's the bottom line.
But the thing is about that is we've already paid the first loan. And now we're paying off the loan that we granted. Where do you think they're getting the money for the student loans?
You're going to have to borrow it from somebody.
Yeah.
Yeah.
No, but I mean, the original student loan was funded by us. Now we got to pay off the loan.
Oh, yeah. You're saying it was somehow, right. Exactly. Yeah. Well, subsidized to a certain extent, but not funded in its entirety. So let's just talk about interest rates. So if you're taking out student loan now, which might actually be the smart thing to do, given what we just discussed, right? Take out as much as you possibly can. Just keep in mind that interest rates are going to be a little bit higher than they were last year. And as I mentioned earlier in the show, there is this rate is determined based on what happens in the 10-year Treasury auction in May. Okay, and so I got another graphic. Hold on, I get there in a second. Okay, there it is. Okay. So what they do is they take so this is all set. There's a formula. It's set by legislation. So it's not arbitrary. They can't just pick a number.
Yep.
And so what they do is they take the highest yield of that Treasury auction and they add 2.05% with a 8.25% cap for direct Stafford loans. And by the way, the government took over student loans. Originally the banks would you would get the loan you could get student loans through the banks. Some of them you would get direct, some you would get through your local bank.
Right.
That's no longer. All federal student loans go through the federal government. They wanted to eliminate the middleman.
Yeah, exactly.
Yeah.
They had to get the money to their higher education support a little bit more directly.
So for federal direct Stafford loans, on an undergraduate, that rate is by formula the highest yield plus 2.05%. So based on the last auction, that rate is going to be 3.73% for all your new student loans taken out for the coming year.
Yep.
Right? If you're a graduate student,
a little less than a 1% increase.
It's just about 1%, right? I'm gonna round that up. It's a 1% increase. By the way, on $20,000 loan, that's about $200 a year if you're not paying down the principal. So that can add up over a period of time. Just 1%.
It's a couple books.
Yeah,
a book,
half a book, half a book,
a book's 3/4 of a book. Yeah.
Oh, by the way, a lot of people don't realize this, but the actual rate is going to be higher than the advertised 3.73% rate. And the reason is because of the fees.
Taxes and fees?
Not taxes, fees.
Yeah.
They charge a fee.
Fees.
The federal government charges
a tax,
fee.
Jeff.
Okay. The federal government charges a fee. So you don't if you take out a $2,500 loan, you don't get a $2,500 loan, you get a $2,450 loan or something like that. I'm not sure what the fees are. So the actual rate is a little bit higher because of the upfront fee. Then the banks have to disclose that. The federal government apparently doesn't have to.
Yep.
And then so that's for undergraduate students. For graduate students, you got to pay a little bit higher rate. And by the way, this is where the big money comes into play, right?
Yeah.
So that rate is the high yield plus 3.6% with a 9.5% cap, and that new rate is 5.28%.
Wow.
Yeah. So for your graduate students, you're taking out loans for law school, 5.28%.
Could buy a house cheaper.
Last year it was 4.3. Not bad. I mean, that wasn't that was a nice rate.
Yep.
But 5.28. This is all because interest rates jumped up for a period of time.
You could get a mortgage at a lower rate than 5.28.
You can. You're right. You could. Don't suggest that you take a mortgage to pay for your graduate school education.
No.
My guess is the government's not going to. What about the families
exactly,
that? Yeah. What about the families? Getting back to the student loan forgiveness question. What about the families that said, "Hey, look, it's cheaper to borrow against the house.
Yep,
I get a lower rate.
Yep.
Hey, I'm just going to do it that way. Plus, it was tax deductible up to a certain extent. So, hey, let me do it that way." My guess is the government's not going to come in and say, "Oh, you borrowed against your house, so let us pay off your mortgage for you."
Probably not.
Not going to happen.
No.
Yeah. And so for
a rude awakening for a lot of people.
plus loans and parent plus and graduate plus loans, that rate by law is the high yield of that May Treasury auction plus 4.6%, and with a 10.5% cap, and now we're looking at 6.28. Again, all of those roughly about a 1% increase. Not a 1% increase, but 100 basis points, a 1 percentage point increase. And the old rate on those plus loans was 5.3%. And by the way, those are loans issued after July 1st.
I find it interesting that a legislative body that's thinking about forgiving student loans are actually raising their interest rates on new issues of student loans. It would seem to be counterintuitive legislation.
But it's by formula.
I know.
So they're not sitting there saying,
but the formula can be changed. Yeah.
Let's raise the interest rates. But why do you think that would be counterintuitive?
Because the whole idea is to reduce the burden.
Reduce the burden
of the student debt.
So why should we be right?
We're raising
Exactly.
Interest rates.
Right.
Yeah.
Hey, and so you actually bring up a good point.
You would think that would be a piece of legislation that they could actually get through Congress.
Yes.
Just to lock the interest rates where they are right now.
Yes. And so that you actually bring up a good point, because your federal direct Stafford loans for undergraduate students can be subsidized or unsubsidized. They can be subsidized if you qualify. You qualify by filing a FAFSA, and as long as your the amount that they think you can afford is less than the cost to attend college, you can get a portion of your loan as a subsidized loan. Usually what happens, I see it all the time, where the school will award a portion of that loan as subsidized, a portion of it unsubsidized, the difference. And it has value, especially with interest rates higher.
Sure.
The subsidized version works this way. And by the way, all student loans have a 6-month deferment. So you don't have to pay, not a 6-month deferment, but they have a payment deferment. So you don't have to make the payments while you're in school. And you have that's true up to 6 months after you graduate. You don't have to make any payments. Yep. However, if it's not a subsidized loan, the interest accrues. You are allowed just to pay the interest if you wanted to, just so you don't see that principal blow up, over a 4-year period. But the difference between the subsidized and the unsubsidized is that the government is paying the interest for you. So while you're in school, if you have a subsidized loan, no interest accrues. You don't have to make any payments, and no interest accrues up to 6 months after you graduate.
Yeah.
That's the difference between a subsidized and an unsubsidized Stafford loan.
Just fascinating. I'm thinking of my now 27-year-old daughter who's paying a student loan and now is forced to buy her own healthcare. But we're worried about the burden of student debt on these kids and getting started. But it's a whole nother subject.
I was going to say a subject for another show. Yeah. All right. So, have any questions about that? Hey, give me a call. I'm glad to talk to you about it. If you have some student loans, you're trying to figure out whether or not you should pay them off or consolidate or whatever. That's kind of discussion that we can have as part of our initial consultation, and a further engagement beyond that initial consultation. So we are going to take a short break here, and I've got I don't know, we're going to have time, Lou, to go over it in detail, but we'll talk about
limit.
it.
We got time.
Well, yeah, that's true too. Yeah, we're streaming, right?
We're streaming.
But I don't want to. People think that we're going to be done by 10 o'clock, and they have stuff to do. I don't want to,
go do your stuff and come back and watch it and replay.
Yeah. Okay. Well, let's get to this break. When we come back, we'll talk about an exception to the premature withdrawal rule if you take money out of your retirement account before age 59 and a half. Stay tuned. We'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. So if you take money, Lou, out of your retirement account before you turn the magic age of 59 and a half.
Yes.
Right? And I'm talking about your IRAs.
Yeah.
Right?
And unqualified.
It's an unqualified distribution.
Yeah.
Right? Not a normal distribution. Right?
There are qualified distributions before 59 and a half, right?
Yeah, there are.
Yeah.
Yeah. But there's also exceptions to that rule.
I see it.
I'm not going to go over all the exceptions, but one of the less well-known exceptions is what they call substantially equal periodic payments, SEPP for short. And that's where you can start taking money out of your IRA based on your life expectancy.
The acronym of that is SEEP.
SEP. SEEP?
SEEP.
SEEP. SEEP your money. Your money seeps out of your IRA.
Seeps. Yeah.
Seeps. It's not a long E. It's a short. Oh, anyway.
Okay.
So you can take money out of your IRA that would normally be penalized.
Yep.
As long as you're taking it out based on your life expectancy. Now you know there's more to that, right?
Yes, of course.
Okay.
Yeah.
So how do you determine life expectancy, right? So there's really three methods that the IRS uses for you to do this, and so this is kind of important.
This ought to be interesting.
This is for somebody who, let's say you lost your job,
Yep.
right, and you got a retirement account,
right,
and you're trying to figure out how you're going to make your mortgage payment or your car payment or whatever, right, or how you're going to live for the next 6 months,
right.
This happened. We use this particular strategy in 2008. During the financial crisis,
sure.
And then most recently because of the pandemic, it gives people a way to access their retirement accounts without having to pay the penalty, assuming they don't qualify for other penalties. By the way, you still have to pay whatever amount that you're taking out that is considered income. You have to pay taxes on. You avoid the 10% excise tax, the penalty of tax, right?
Yep.
And so there's three methods that you can use. One is called the required minimum distribution method. Another is the fixed amortization method, and the other is the fixed annuitization method. Okay. And I'm not going to go into great detail here, except to say that with the required minimum distribution method, what you do is you use a life expectancy table, and you look at the value of your account at the end of last year. You divide that amount by your life expectancy, and there's a couple of tables that you can use to do this. The same tables, by the way, that people who are forced to take money out, required minimum distributions,
yep.
which is why they call it that would use. And so you just divide the balance at the end of last year by your life expectancy, and that's the amount you can pull out this year. You have to take it out. Here's the key. You have to take it out for a period of time. You can't just do it once.
Oh.
It has to be substantially equal periodic payments, right?
Mm-hmm.
Those payments have to continue for at least 5 years or age 59 and a half, whichever is longer. So if you're 30, you got to take it out until you're 59 and a half. So plan on taking it out for 29 and a half years. So this is not something that if you're real young, you necessarily would want to use. But
right.
Let's say that you're 55.
Mm-hmm.
right?
Yeah.
And you only have 4.5 years to turn 59 and a half. You only have to take it out for a period of 5 years. Gives you a way to pull money out of your retirement accounts and not have to pay the penalty, right? So
that would reduce your payments, right? So 1/5. I mean, it would actually increase your payments.
Increases payments because your life expectancy is lower,
right,
at an older age. Is that what you're saying?
As life expectancy based on the 5 years between 55.
No,
4 years
no. Life expectancy. Regardless of what age you are, it's all based on life expectancy. Gotcha. So if you're younger, your life expectancy is going to be longer. Your payments are going to be less. The amount you can pull out is less. Right. Another way to do it is a fixed amortization method, where you take and you use a reasonable interest rate. You figure out how long your life expectancy is, and you take your balance at the end of the prior year and you amortize it over that period of time, and you have a fixed payment.
Yeah.
So with the required minimum distribution method, you have a new payment every year,
right?
Because your balance changes.
Yes.
And your life expectancy changes, right?
Oh, interesting. Yeah.
Yeah. But with the fixed amortization method, you figure out one amount based on how amortizing the entire balance of your account at a reasonable interest rate over your life expectancy. Get that?
Yep.
The other is
easier to plan.
Yeah. The other is the fixed annuitization method, where you use an annuity table instead of a
life expectancy.
Amortization. Life expectancy. Right. Use an annuitization table. Basically, 6 of one, half a dozen. It's not exactly the same.
Yeah.
But you can choose which method you want. Once you choose it, you have to stick with it, with one change over the course of that plan.
Oh,
right.
Okay.
Another thing you have to keep in mind. This is something that you probably don't want to do at home, but without some professional advice, right? The other thing that you have to keep in mind is that, as I said before, you can't deviate. You have one time you can change from one plan to another. By the way, if you stop taking it out, you don't need it anymore. You got a big job and you don't want it. They go back and say everything you took out is no longer considered accepted.
Wow.
And you're going to pay a penalty plus possibly interest on the taxes that you didn't pay.
They call off the deal.
Wow. You have to stick with it for 5 years or 59 and a half, whichever's longer.
Wow.
Right?
Yeah.
But here's the thing. You don't have to include all your retirement accounts when you do this calculation. You can set up a separate SEPP for a particular account.
Interesting.
Yeah. So let's say that you want to make the mortgage payment, for example, right?
Yep.
So we calculate how much you have to have in an account to make the mortgage payment now for the next 5 years, or age 50 up until you're 59 and a half, right?
Yep.
You just apply it to that particular account. You put the money in that account, and that's it. And that account is set up specifically to make those payments for you over that period of time. The rest of your money can be invested and totally outside of the calculation. Or you could then set up another program for that account, or multiple accounts for that matter.
See, nuance and proper planning makes all the difference here.
And be careful about rollovers. Let's say you get set up an account.
Yeah.
And you've got these payments coming out. There's a lot of
pitfalls. There's a lot of ways.
A lot of pitfalls.
Yeah.
If you want to change your custodian and you want to have that money invested differently, be very careful about rollovers. And again, not something that you want to do.
But if you're forced to make a withdrawal, an unqualified withdrawal before 59 and a half,
this is one exception.
Someone should talk to you.
Yeah, this is one exception, and maybe you qualify for another exception, so you don't have to do something like this. But it is another way to get money out and pay less taxes on it. That's the bottom line, right?
Exactly.
Yeah. How do we do? I get that done.
You did.
Yeah, we're a little bit over time, but we got it all in. Great. Excellent. Okay. Terrific. Hey, if you want to get in touch with me after the show, call the toll-free number, 877-475-2062. Send me an email, jeff@talkmoneyradio.com, or send us a message right on the Facebook page. We'd be glad to sit down with you. And we still are, we're going to continue to do virtual meetings. But if you'd like to come in and shake my hand and meet face-to-face,
you're welcome to.
Yeah, welcome to do that as well. But we can work long distance as well. And happy to have a virtual Zoom call with you for that initial meeting. So No live show next
that's
week
right.
because
July
it's the
5th.
July 4th celebration,
Mhm.
the Monday next week, and we'll be back the week after that.
All right.
Remember, in the meantime, good sound advice is much better than advice that just sounds good. Thanks, Lou.
You got